Starting from a daily chart, we can see that the market comes from 2 days of expansion. The open here is Thursday. This is the day before NFP. All right, so there is an argument as to, or at least enough narrative as to why the market could consolidate today. Not because of the fact that it's the day before NFP, but because of the fact that the market comes from 2 days of expansion. So in terms of premium array, especially if this is going to be a consolidation day, previous day high obviously, any divergences around that level, or again if it were to both the S&P and Nasdaq were to trade above, then a session divergence happening at these levels. In terms of discount array on the daily, we obviously have an order block, but price shouldn't revisit this level. Ideally, to me, it shouldn't even revisit at least today. Okay, it shouldn't even revisit the range of the previous day's low, which has a volume imbalance. Right, there's also a volume imbalance here between the closure of Monday and the open of Tuesday, and in between these two volume imbalances, there's a fair value gap. Okay, so suspension block at these levels. 25% of, so the upper quadrant of the suspension block aligns with 50% of the fair value gap. Okay, so again, not that this is relevant to today. I don't think that this will be relevant to today, but you never know, right? You never know, the market reverses for whatever reason the range, right? So if it does, okay, these are key discount rates inside of the range. But most importantly, we'll look at some discount arrays inside of the previous day's range when we look at the hourly chart. So 2 days of expansion, day before NFP. Okay, so I wouldn't be surprised if we see some kind of consolidation day. If it's a reversal day, I need to see a divergence. Ideally, with the previous day high, okay, one takes it, the other doesn't. That would be the best case scenario. If not, it could be a session divergence. Okay, so reversal, consolidation, and then for some kind of expansion day, we have to look inside of the previous day's range. On the 4-hour chart, in terms of a 3-week look back, I mean, at this moment in time where price is, the previous week's levels are pretty irrelevant, okay, because price on Monday retraced inside the 4-hour fair value gap, left at 25% of the previous week's range, and has expanded from there, right? So we have a lot of key levels inside of this range. Okay, I wouldn't assume that the market will come back inside the previous week's range this week, right? I think at most, we can see if today expands, right? Friday could be NFP, could be a consolidation day. If today consolidates, right, then NFP could see another expansion. Okay, it doesn't have to see a TGIF retracement, in my opinion, if today consolidates. And again, even if today, say, were to be a reversal, I believe that there's enough discount PD raise in this range to hold price as support. This could be, say, something like this. I don't even believe that it's going to come, even if this is a reversal day. I doubt that it's going to come back to the previous day's low. It could be, but I doubt. Right, the order flow is bullish. It's hard for me to assume that the market will want to come back to any of these levels, before it starts proving it to me. I would rather just keep assuming that it's going to keep trading higher than start looking for scenarios, right, as to why price could come back in the range before a reversal setup even happens. Look at a 3-day look back. Here we can look at the current weekly profile that we're trading inside of. Okay, the market is, well, we have a Monday low of week inside a PD ray of interest inside of the previous week's range, as we saw on the 4-hour, and from there the market broke broke structure, right? Started trading higher. We can see that currently price has spent the most of time inside of this range, around 50% of the curve. Okay, so say today consolidates, right? Likely this will be shifted at these levels, and will create some kind of new PD ray of importance for us to have in our chart for Friday, right? Friday NFP. In terms of standard deviations, I'm currently using the double purge of Monday. Okay, right. Since this is the low of week, I'm using the double purge as standard deviation. You can see that the market created a range of consolidation that was preceded by a breakaway gap at minus 0.5 standard deviation. Eventually trades into 1 to 1.5, finds a new phase of consolidation, expands into minus 2 standard deviation, retraces back inside the range, right, inside of this range. And so, you know, if today will end up being a reversal profile, then it can be good enough to create the high of week, okay, something like this, right? Maybe leave a chop, right, but leave some kind of PD ray here, either in discount or premium for Friday to trade off. But overall, I would say that, again, I don't want to assume that there's going to be a shorting opportunity, right? Clearly, the market just wants to keep trading higher, which is totally fine with me. This can be a good draw on liquidity for the week. Okay, so the range above 29,000, right? 29,000 comes at these levels. Again, this doesn't mean this needs to be today, right? This doesn't have to do this today, but it's something to keep in mind. Say if today consolidates, right, into Friday, if Friday has a shakeout, okay, this can be a good draw on liquidity for the week. So in terms of a weekly profile, all we really have left is, in my opinion, a classic buy profile or some kind of swing that ends up being a Z. Okay, if today and Friday end up creating some kind of range at these levels. Now, for today, right, if we look at the previous day's range in terms of levels of interest, if we look at the previous day's profile, which was a classic buy profile, okay, we can see that the order block, that the market left an important order block. Why is this an important order block? Because this here is a phase of accumulation of longs, okay, that lead to a shakeout. There's a divergence at these levels with the S&P 500, and you can see that the shakeout also leads to the creation of an intermediate term low at these levels. Okay, so the market on a lower time frame perspective is currently trading inside of this dealing range. I wouldn't consider the previous day's low to be the dealing range because it didn't have any shakeout, right? The expansion that we comes from this shakeout here, right? So this is the dealing range. Overall, like, in terms of PD area of interest, if we look at the previous day's range, we can see that so far price has gapped down, has found a lower time frame rejection at the highs, and has gapped down at the open. So it's hard for me to assume that either this or this fair value gap will be enough, okay, to create a low of day, such as yesterday. Okay, right? The difference between yesterday and today is that yesterday gapped higher while today gapped lower. Right? Yesterday, in fact, this was the PD ray. This was the PD ray of interest, and you can see how price was very sensitive. And what I was saying was that if price is going to be really bullish, right, doesn't need to come back inside of this fair value gap. Because it gapped up and created a fair value gap, it could simply expand and create the low of day from these levels, right? And New York even coming back, touching the high of that fair value gap, and expanding from there. So, right. So because of these reasons, I don't believe that price will be making a low of day at these levels. Could it do it? Sure, right? A quick shakeout at these levels, trades higher, respects the fair value gap, this fair value gap cuts through not only an order block but also a mitigation block here, right? Price went from high, price went from a low to a high to a low to a high to a low to a high. Okay, so I wouldn't say PDA of interest for the day, but it's nonetheless still a relevant PD rate because of where it's located in the range, but also because of the fact that it cuts through a PD rate. Okay, so at these levels, even if say today were to create something like this, right, trade under it, but eventually is bullish, right, very likely I believe that this fair value gap will get reclaimed and the market could trade higher from these levels. Coming back to the previous day's range, the main PD rate for me is this, right, the order block. Why? Because it's located at 50%. Okay, the usually high probable order block tend to form around 50% of ranges. There's even another range of order block that's located inside of the bigger one, right? So in here, price was high resistance, right? If we were to look at, say, a lower time frame chart, obviously, first thing you can see is the intermediate term low at these levels, right? Closed an hourly fair value gap, and on the lower time frame, it looks like an inverse head and shoulder, right? That's what an intermediate term low looks like. But what you can see is that at these levels here, the range is high resistance, right? Price went higher, lower, higher, lower, higher, lower, higher, lower, higher, lower, higher, low, right? A lot of chopper on this range. So range is high resistance and also has been mitigated. No, sorry, it hasn't been mitigated. The breaker has been mitigated, right? This is the breaker. Why? Because it was the final accumulation of shorts into the shakeout, right? The shakeout which ended up being divergence. And then from those levels, the market broke structure. So just out of curiosity, we can even look at standard deviations for this range. Right, we can see that the market traded to 0.5, came back inside of the range of the breaker. From there, expands into 1 to 1.5 standard deviations, right? And so the argument now is, will the market, because the market found a rejection at the previous day's high and has gapped lower, okay, could it do something like this, right, around the range of the, somewhere in here we have the mitigation block. We'll go back on the hourly soon. Okay, the market could do this, or let's say it chops and then sees a shakeout, right? That could be enough for price to trade higher. So these are relevant standard deviations because price is currently inside of this dealing range, as I talked about before, right? And this is where it's important structure, right, on the hourly. It's the last swing low that formed on the hourly. Okay, so coming back to the previous day's range, again, we have a range of fair value gaps here at 25% of the previous day's range. These cut through the wick high of the order block and the mitigation block. Okay, so these, if price is really bullish, this can be enough to create the low of day. At 50%, we have the range of an order block. And at 75%, we have the range of not only a fair value gap, but also the intermediate term low, right? The current dealing range that price is inside of. So personally, I'll be keeping this level on my chart. I think that this is the most obvious to the eye level, right? I could be picking a fair value gap in here, but again, because of the rejection at the previous high, because of the gap down, right? Price is already essentially trading inside of these fair value gaps. So I don't believe that it will be enough to create the low of day. It definitely can be, okay, right? Say if it respects the upper quadrant of the bearish order block that has a fair value gap, has another order block, right? We can see that this order block cuts through 50% in the upper quadrant. So pretty strong range. Okay, so keep these levels on your chart. Right, keep these levels on your chart. I was thinking, right, if this level can also be used in terms of inversion. I'd say the market does something like this, creates a divergence at the highs, and then starts to trade lower. Then sure, I think that the market could be using this level as an inversion level. Obviously, this fair value gap here will probably be important to order flow. Okay, in case of something like this, right? Say if fair value gaps are left inside of this range and it cuts through here, right? Then he pop back above if the profile is right. I can deliver to lower prices. But that would only be a scenario for me again if there's a divergence. If there's no divergence at the highs, I cannot assume that the market will keep trading lower. Okay, so best case scenario for me tomorrow is something similar to this, either the upper quadrant or 50% of the order block is revisited before the market trades higher, or if it's not going to be this, which is best case scenario, I believe the market will do something like this. Some kind of consolidation, because again, there is enough narrative on the weekly profile standpoint to see a potential consolidation profile today. Okay, so important order block, again, why? Because of where it's located right at 50%. High probable order blocks tend to form around 50% of ranges again. So right, even if the market is very, very bullish, it could simply use the wick high here as, again, there's that fair value gap that cuts through it. If it's really bullish, it could simply do this and keep expanding higher. If, right, this is not going to be say a classic buy day, then I believe that the market could come back all the way down to 50% of this order block, leave some kind of divergence inside of the range, and then end up trading higher back in premium, where it'll either displace or reject, right, and create something like this. So keep this level on your chart in terms of premium buy side target. Okay, 29,000. This aligns with the standard deviation of the current week. Look, if today will be a reversal profile, what can you target as a low-hanging fruit target? It obviously all depends on where the reversal happens. Okay, say the reversal is something like this, then at this point you still have enough of a range of ticks here to say even just trade towards the high here of the order block. It's hard. It's definitely not easy to. I just don't see the shorts, and so because of that, it's hard for me to say where the market could potentially stop at. Right? We can use session-based liquidity, okay, in terms of sell-side pool. PM session low. You can use lunchtime low at these levels, okay. There's this right below here. We have 50% of this order block. So in case of a reversal profile, you can target this as a low-hanging fruit, but I wouldn't be confident in targeting anything else. Honestly, anything else past 50% of the order block. Right, if the market were to present a open high low close profile, if there's enough of a range of ticks for me to go get right somewhere in here, then I can take the trade. But if the market is already too close to these levels, I would rather just wait and see the reaction instead of trading short towards it, because I believe that very likely, right, it could start reversing, right, reversing back higher, and again either fail in premium or expand through premium. Okay, so keep this level on your chart.